This is Mark to Market, a podcast of BT Correspondents.
Hello, everybody. Welcome to Mark to Market, a BT Correspondents podcast that aims to provide analysis and insight on market trends and corporate issues in Singapore. My name is benpaul, and I'm a senior correspondent at the Business Times. Every week, my colleagues and I delve into a business story that matters. We're in the month of March 2025, and I can't believe I'm saying this, but the one thing everyone seems to be talking about right now is the Singapore stock market. There are two reasons for this. The first is that the Straits Times Index has been hitting new all-time highs. According to the Singapore Exchange, the STI hit a high of 3,906.16 way back in October of 2007. Now, it breached that level during the trading session on the 10th of February this year, and it's held up quite well since then. The STI's last close before this podcast recording was 3,915.87. For many investors, this wasn't really a cause for celebration. If anything, the fact that it's taken the STI almost 18 years to mark a new high underscores why there's so many Singapore investors who are disappointed and disgruntled, and why delistings have outpaced new listings in the Singapore market for years. But if you zoom in and just eyeball a 5-year or 10-year chart of the STI, it appears that the local market has regained some vigor since late 2023. This was around the time when it was becoming clear that the post-COVID bout of global inflation was getting back under control, and that global central banks, in particular the US Federal Reserve, were going to start loosening monetary policy. From that point, the STI really began to power ahead, and that momentum has driven it to its new all-time highs. Now, I'll talk more about what's been driving the STI and what might keep it going later in this podcast. But let me first get on to the other reason the Singapore stock market has been such a hot topic of conversation. On the 21st of February, the Equities Market Review Group announced its first set of measures to revive the Singapore market. This review group was formed by the Monetary Authority of Singapore in August last year, and there were 3 areas of focus, namely encouraging a pipeline of quality listings, or the supply side of the market, so to speak, enhancing investor participation and broadening market liquidity, which refers to the demand side of the market, and re-evaluating Singapore's regulatory structures and approach. After months of studying the problems with the Singapore market and consulting with various stakeholders, the MAS Review Group came up with an initial set of proposals for all 3 of these areas. On the regulatory front, for instance, it said it will, among other things, streamline the listing process and adopt a more targeted approach to post-listing queries, alerts, and trading suspensions. On the supply side of the market, the review group said newly listed companies in Singapore will get corporate tax rebates of 20%, and fund management outfits that list and pay dividends will be given an enhanced concessionary tax rate of 5%. The government will also enhance support for the development of local enterprises in order to provide a pipeline of potential listing candidates. But it was the demand-side measures announced by the review group that really grabbed everyone's attention. In particular, MAS said it will farm out $5 billion to fund managers investing in Singapore stocks under what it calls the Equity Market Development Program, or EQDP. The fund managers must have a good track record, venture beyond index component stocks, and be willing to expand their operations in Singapore. To complement the EQDP, there will be tax exemptions on fund managers' qualifying income arising from funds investing substantially in Singapore stocks. Another significant demand-side measure is that the Global Investor Program, or GIP, will be tweaked to drive more capital flows into the Singapore market. Specifically, GIP applicants setting up single-family offices must allocate $50 million of the required $200 million in assets under management to equities listed on Singapore-approved exchanges. GIP applicants were previously allowed to invest this $50 million in a broader range of assets, including debt securities and non-listed Singapore-based companies. Now, the idea of these extra funds flowing into the Singapore market is potentially exciting in my view. This could help improve liquidity, facilitate price discovery for small cap stocks, encourage companies to focus on shareholder value, and most importantly, serve as a catalyst for more private sector investment inflows. But this excitement I'm feeling might also be partly a reflection of low expectations on my part. The idea of systematically channeling a portion of Singapore's savings into the market had been mooted from the outset. It seemed a logical thing to do. Instead of exporting Singapore's domestic savings to foreign markets, it seemed to make a lot of sense to allocate some of those funds to keep the local market humming. In the minds of many market watchers, the simplest way to do this was to have Temasek or GIC invest a portion of their assets under management in Singapore stocks. But this was a non-starter as far as the government was concerned. Second Minister for Finance, Chee Hong Tat, who is also the chairman of the review group, had said from the get-go that the government did not want to meddle with GIC's investment mandate. In fact, just a week before the review group unveiled its first set of recommendations, Chee reiterated why the review group was not prepared to recommend that GIC use its funds to boost trading liquidity in the local market. He said GIC's mission is to preserve and enhance the international purchasing power of Singapore's reserves, and he explained that GIC's mandate already allows it to invest in Singapore companies with a global footprint and that can generate good returns. So GIC should be left to make its investment decisions professionally and commercially and not be required to have a specific allocation to local equities if such investments result in lower overall returns. Chee also said that he did not believe it is sustainable to use such a pump priming approach, and that it would be more effective to look at how the fundamentals of the market ecosystem could be strengthened. So even though a lot of people were talking about the need for Singapore to direct a portion of its domestic savings to the local market, this ambivalence on the part of the government made it unclear whether the review group would recommend any big demand-side measures. The fact that the review group did make the recommendation and it was heard, I think, is very positive and a clear sign this high-level effort to revive the Singapore market should not be underestimated. But are demand-side measures really the answer? Are the EQDP that MAS has launched and the tweaks to the GIP just pump priming measures that will ultimately fail? I'm going to talk about that next.
Money Hacks by the Business Times delivers useful financial tips every Monday. Subscribe to the playlists in Spotify, Apple Podcasts, or wherever you listen to podcasts. But if watching is your thing, we've got you covered. Subscribe to the Money Hacks playlist in the podcast tab of BT's YouTube channel and watch as Howie Lim gets the inside scoop on the best money hacks. Subscribe and watch today.
And now, back to Market, a podcast of BT correspondents.
Earlier in this podcast, I mentioned that the Straits Times Index has advanced strongly since late 2023 and has recently been breaching the highs set in October 2007. Since the end of 2023, the STI is up about 21%, which compares quite favorably to the S&P 500's gain of nearly 25% and the Dow Jones Industrial Average's advance of 16% during the same period. And I'm just talking about raw price gains here. On a total return basis, the STI's relative performance would have been even better because Singapore's leading companies are big dividend payers. But here's the thing. The STI's gain during the period was driven by a narrow group of companies. Only 11 of the 30 components of the STI were in positive territory at the time of this recording. In comparison, more than 2/3 of the S&P 500's components and more than 4/5 of the Dow Jones Industrial Average's components ended the same period in positive territory. So which of the STI's component stocks drove it to new record levels recently? The best performer was Yangzijiang Shipbuilding, which, even after its recent sell-off, was up more than 80%. The 11th best performing component of the STI was Singapore Airlines, which was barely in positive territory with a gain of about 2%. The other 9 STI components that were in positive territory since the end of 2023 have all delivered double-digit percentage gains, ranging from more than 50% in the case of DBS to nearly 11% in the case of Sembcorp Industries. Now, the one thing all these gainers have in common is that they've all been delivering shareholder value. For instance, DBS, OCBC, and UOB, which account for half the STI, have been through a few years of very elevated profitability as interest rates rose. And all three of the banks have been returning substantial amounts of excess capital to their shareholders through increased dividends or share buybacks. On the other hand, Hong Kong Land and Singtel, which are both up about 30% since the end of 2023, are actively unlocking value and repositioning their businesses. Elsewhere, SATS, which was up nearly 12%, and ST Engineering, which is up 30%, have made bold strategic investments to enhance their business profiles. My point in all of this is that investors in Singapore are not apathetic. They will pile into companies that deliver shareholder value. And the way I see it, the key to a more vibrant Singapore market is to coax and cajole more companies to unlock value and improve their financial performance in a similar fashion. Coming back to the MAS Review Group's first set of measures, my sense is that it has done little to win over the skeptics, and there is still a lot of doubt that it will ultimately succeed in its mission. Some of this skepticism is well-founded. The strong performance of the US market over the past decade has made it an overwhelmingly powerful magnet for listing aspirants and investors from around the world, including Singapore. This is going to be hard to overcome. Furthermore, the surge in availability of private equity capital over the past couple of decades has led to startups remaining private for longer and achieving significantly greater operational scale than their predecessors before going public. As a result, the pace of new public listings has slowed around the world, including in the US. Another problem, and this is perhaps the main problem, is that people simply have different views on why the Singapore market has performed so poorly, and consequently, on what the review group's priorities ought to be. As I mentioned a moment ago, companies within the STI that have worked to unlock value and improve their profitability have performed quite well and helped drive the benchmark index to new record highs. So I can't help feeling rather disappointed that the review group did not recommend some specific value-up initiatives as part of its first set of measures. By the same token, it seems clear from online comments to some of my social media posts that some market watchers feel that corporate governance standards have slipped and that investor confidence is not going to improve until that matter is properly addressed. And by the way, some of the local corporates have the opposite view, which is that there is already too much regulation and that the rules are cumbersome and ineffective. This is something that the review group has evidently taken on board in its first set of measures, given its emphasis on taking a more pro-enterprise regulatory stance and moving decisively towards a more disclosure-based regime. So the point I'm making here is that market participants not only have different views about what needs to be fixed, their views are often in conflict with one another. And it's all the more difficult for the MAS Review Group to get everyone to agree on a direction, given the accumulated cynicism in the market after years of unsuccessful attempts to draw more new listings, including through subsidies to defray the cost of going public, through the $1.5 billion anchor fund at 65 to shepherd promising companies to a local listing, and let's not forget the belated introduction of SPACs, or special purpose acquisition companies. A lot of things have been tried with little to no success. But here's what I think the skeptics are missing. The long-term underperformance of the Singapore market is the result of several interrelated factors. Problems such as the lack of exciting new listings, the shortage of good quality equities research, and even the lack of attention to corporate governance issues are all symptoms as well as causes of the general dysfunction in the market. The reason I'm quite optimistic about the MAS Review Group's efforts is that it isn't trying to address one or two problems in isolation. Instead, it's taking a holistic approach to fixing everything that's broken. While some market watchers may worry that having MAS farm out $5 billion to local fund managers is a poor use of public sector money, or that meddling with the GIP to drive capital flows into the local market may have unintended consequences, such as attracting the wrong kind of family offices, I think it's important to keep in mind that the review group is not going to stop there. Besides the initiatives announced on the 21st of February, the MAS Review Group also provided a laundry list of measures it is still studying. And gratifyingly for me, These include getting companies to sharpen their focus on shareholder value and shareholder engagement, which, in my view, would help the demand-side measures gain traction. The review group is also looking into better enabling investors to seek recourse and recompense for losses due to market misconduct, which is going to be important in making a more pro-enterprise disclosure-based regime work properly. Other initiatives that might be in the offing include a possible shake-up of the Catalyst board, the modernization of the Central Depository's post-trade custody infrastructure, and even adjustments to the board lot size. In short, it appears that just about everything is on the table. In the end, the real test for the MAS review group's efforts could be whether there is a sustained positive reaction in the market. This would be a clear sign of confidence in the review group's measures, and it could help galvanize support for much-needed reforms in the Singapore market. That's it for this edition of Mark to Market. BT Correspondents will be back next week with wealth editor Genevieve Kwok, so please keep listening. If you have any thoughts or questions about the show, email us at btpodcast@sph.com.sg. I'm benpaul. As always, thank you for listening and join us again next week.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts. Or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.